Good morning, we are Group 4, Maria Gracia Chini, Jacqueline Vial, Rhiannon Lee, and Carmen Dennis. Today we are going to present to you by recommendation of JP Morgan. Rhiannon, can you tell us something about this?
Sure. JP Morgan is an American multinational banking and financial services holdings company. It is the largest bank in the U.S. with assets of $2.57 trillion as of 2011. It is also the second largest in market capitalization, with $225 billion after Wells Fargo. 75% of JP Morgan's business focuses on the U.S. market. The remaining 25% is on its global business segment. U.S. GDP single-handedly accounts for one-third of the global GDP, so JP Morgan is fueled by a healthy U.S. economy. Despite being players in Europe, Asia, and emerging markets, a higher concentration in the U.S. benefits JP Morgan due to its current relative strength.
Today the price is at $60.15, but we have a price targeted within the next 12 months at $68 due to the consensus of Wall Street that is depicted in the target prices of 40 specialized analysis. When buying, there are some risks to be considered, although we believe them to be outweighed by the performance of JP Morgan. The first risk is the unavoidable systemic risk that comes from correlation between the general market and stocks. A heavy dependence on the American market would be identified with this type of risk. Next is the risk of interest rates that may begin to rise as the economy has begun to get moving again. As interest rates rise, the net interest margin of JP Morgan would tend to decrease. Third, because the CEO was diagnosed with throat cancer, there is a risk of management changes. Fourth, the global exposure of JP Morgan causes the operations abroad to be subject to their trends, whatever they may be. Lastly, due to a domino effect, if the net interest margin of JP Morgan decreases, there may be a risk of being forced to limit dividends so as not to surpass their desired payout of ratio. We don't suggest heavily relying on news in order to consider buying, since this is an inefficient method. Once the news get out, the price jumps. However, two ideas are: first, empirical evidence shows that JP Morgan reported earnings per share have consistently outperformed their estimations. Therefore, we encourage buying before the mandatory quarterly reports come out because once they do, the prices are sure to go up. Second, after the 2008 crisis, Federal Reserve enforced a mandatory stress test which studies the reactions of banks to a hypothetical financial crisis. The last results, released on March 5th, show that JP Morgan performed well above the capital rate required by the central bank. So, to conclude, we encourage you to buy stocks of JP Morgan, who is unlikely to underperform.